Hi everyone, this is Jason Burak of Wall Street for Main Street. Today is Saturday, June 19th, 2010. This is not a commodities market wrap-up or anything like that. I just wanted to tell you about more details about BP as a trade. I do not think BP is currently a long-term investment. I think it is a very, very poor long-term investment, in fact, at least until more bad news is priced into the stock. So let me show you some of the risk-reward analysis and give you some more positives and negatives besides the article I wrote about BP. Let's go further in depth, and let's talk about some of the more news stories. First of all, the amount of spill estimates have been upgraded by BP and I believe the White House to about 60,000 barrels a day. That, I believe, is still incorrect and nowhere near enough. Based on Matt Simmons and other scientists I've read, and Matt Simmons has actually talked to a lot of scientists, and there's also this Thomas Jefferson research vessel. It's an underwater submarine. It's considered the best one in the world, and that is now mapping the ocean floor. And Matt Simmons says that about 40% of the entire Gulf of Mexico is covered underground in oil, which is very, very bad. But what I think has happened is 120,000 barrels a day has been spilling from day one. I think it's a no-win scenario for how to stop the spill. I think they're damned if they do and they're damned if they don't. Either they try to do nothing and literally the spill continues for another 10, 15, 20, or 30 years at that rate, and maybe they could slow it down, or they try what Matt Simmons was suggesting with the nuclear option. I don't think either scenario is good, and I'm just glad I'm not making the decision. Although if the nuclear option and people are saying it's bad, at least you would have the Army Corps of Engineers involved. This would not be BP doing it. This would be a military operation. So this would be the U.S. Navy. This would be the government taking over. This would be the U.S. Navy and the Army Corps of Engineers trying to make sure that they use a very, very small nuclear device and that they are able to get the rocks to cave in on the underground well below the ocean floor. Because all that oil, literally, it's pressurized, but it's literally just an underground lake of oil that's underneath the ocean floor, and the pressure's forcing it up. So if they could get the rocks to collapse on each other, they can stop the oil from spilling. So that is still an option, still on the table. I know people don't like it, but would you rather have oil spilling for 20 or 30 years at a high rate or that? So I personally don't think either one's good, but at this point, it's a no-win scenario. Like I said on the Wall Street for Main Street fan page, it's kind of like what they taught Captain Kirk in the Star Trek school. It's the no-win scenario that Captain Kirk wins by cheating, and he had Spock's help. But I wanted to talk about BP as a trade. I am 100% sure that all of the bad news and all of the risk is not priced into BP stock currently. BP is currently above $31 a share. And I think that is far, far, far too high given the risks that BP faces. Fundamental analysis of BP concurred that BP only had about $8 billion worth of cash and cash equivalents at the end of fiscal year 2009. So probably as of now, BP has even less than $8 billion in cash in the bank, and they have suspended the dividend. So what people don't realize is that these big, large mutual funds that are holding millions upon millions upon millions of BP shares, and also pension funds that are relying on dividend income, when a big company like BP suspends or cuts the dividend, these guys are going over the next 3 to 5 months to be dumping all their shares of BP. This will not happen immediately, as the stock will tank immediately, and they don't want that to happen. So let me explain some of the process. Market makers in general, when a mutual fund company wants to dump this many shares of a company, they go to a market maker. They tell the market maker to churn and burn the stock. They tell the market maker to bring the shares up slightly into higher volume so they can dump the shares and make everyone else think the stock is going up. This is kind of a short squeeze. There's also hedge funds involved in this who have jumped the gun, who have overshorted it. The best way to play BP as a trade, and this is just my opinion and Mo Dawood's opinion, okay, based on my research, so to help you guys out, and I'm going to show you how to calculate risk and rewards. I think there's a lot of positive, there's a good risk reward on this trade here. As far as that goes, I think the best way to play BP is to the downside. I think it offers a lot more profit potential. The best way to get to profit off of this is to not directly short BP. It is to buy puts. The best puts I am looking at, and Mo Dawood is looking at, are the January 2011 $20 strike puts on BP and the January 2012 $20 strike price puts on BP. Let me read you what they're currently trading at. The January 2011 $20 strike put on BP is only $207 a contract plus your broker's commission. So basically then, if that BP stock drops below $20 a share, your puts become in the money. So you only paid about $220 per contract. That put would then be worth about $2,000 approximately in profits if you exercised it or if you sold it. The risk to reward ratio, you're only risking a couple $100 to make about a couple thousand. That would be very good for January 2011. For January 2012, you would give yourself even more of time to let this play out. I think BP is looking at a bailout. They're going to have to sell assets. Their dividends cut. The stock definitely faces a lot further downside risk. The January 2012 puts are only another $160 or so per contract to give yourself another year to let this play out. I think there's a lot more money to make on BP as a trade to the downside betting on them. Now, with that being said, I mean, we're investors and traders. We're here to make some money, guys. So this is just an investing idea. Do your own research. But I think the risk to reward ratio, based on all the risks that BP is facing and the bad news and the lawsuits and the cleanup fees and all the other stuff, considering this, that they have these drill ships that are soaking up the oil and the spill hasn't even stopped yet. They haven't even gotten the spill to stop. They've only soaking up some of the barrels. So I think this is going to continue for many, many more months. If we're lucky, it'll only last a few more months. But hopefully we don't have to resort to nukes. But I'm not a scientist, so I've just been learning some of the technical jargon as we go and how to potentially profit off of it. I think the risk to reward ratio for buying out of the money puts to the downside, giving yourself a good amount of time on BP is very, very favorable. Okay, thanks guys.